Hello, and thanks for joining us for our quarterly investment perspective review. I'm Aldo Vultaggio, Chief Investment Officer at Capstone Financial Advisors. The following is general commentary on the markets and economy and his opinion. First, a quick market review. In the first quarter of 2025, markets hit turbulence. U.S. stocks pulled back sharply as early signs of sweeping new tariffs triggered policy uncertainty and a correction in tech and growth stocks. Meanwhile, international stocks, especially in Europe and Asia, held up better, helped by government stimulus, defense spending, and a weaker U.S. dollar. On the flip side, bonds played their role as a stabilizer. U.S. bond markets delivered solid gains as investors sought safety and long-term rates declined. While international bond returns were more muted, bonds overall helped cushion portfolios against the equity pullback. Looking ahead, markets face continued volatility driven by policy uncertainty, tariffs, and shifting economic growth expectations. But with U.S. stocks already repricing significantly, the setup for forward returns is improving, especially if earnings hold and policy clarity emerges. International equities may offer relative strength, supported by compelling valuations and stimulus in regions like Europe and China. On the bond side, high-quality bonds remain attractive in this environment. Their elevated yields provide a solid foundation for returns, with added upside if economic growth slows or interest rates move lower. On the economic front, the U.S. economy held up well in the first quarter, showing steady growth despite policy noise and market volatility. Job gains, retail sales, and business investment remained solid, especially early in the quarter. But by March, sentiment began to cool as rising uncertainty and tariff concerns weighed on both consumers and businesses. Abroad, economic growth edged higher with regional variation. Europe benefited from increased government spending, while China's stimulus helped boost domestic momentum. Although inflation and trade frictions remain challenges, global activity showed signs of modest improvement after a sluggish end to 2024. Looking ahead, the U.S. economy is expected to slow as policy uncertainty and trade tensions weigh on consumer spending and business investment. Inflation may remain sticky due to rising import costs, but strong household balance sheets and healthy corporate fundamentals could help cushion the downturn. Internationally, the outlook remains uneven. Europe is seeing support from government stimulus, while China's recent policy moves are starting to boost credit and consumer activity. Trade-related headwinds persist across many regions, but targeted economic responses may help ease some of the pressure on global economic growth. On April 2nd, the White House announced sweeping new tariffs on U.S. imports, triggering a wave of investor concern and sharp market volatility. Unlike the 2017 trade measures, these tariffs are broader, applying not just to China, but to most major trading partners, with a new 10% universal tariff, country-specific reciprocal tariffs, and 25% product-level tariffs on key goods. Just 1 week later, the administration took steps to dial back the pressure. On April 9th, a 90-day pause was announced on reciprocal tariffs above 10% from most countries, though China was excluded. 2 days after that, exemptions were added for smartphones, computers, and other tech products. While the worst-case scenario has likely been avoided, the remaining tariffs are still significant and could impact both inflation and growth. Before the pause, estimates suggested the average effective tariff rate on imports could have surged past 30%. Even now, with the partial rollback, the rate may remain over 25%, far above the pre-April average of around 3%. But the concern isn't just about the tariffs themselves, it's how businesses and consumers react to the uncertainty they introduce. Policy-driven uncertainty has already increased sharply, leading to delayed decisions and elevated market volatility. Still, some tariffs may prove temporary if they serve as negotiating leverage. While it's too soon to predict how things will unfold, we've seen before that markets and economies can weather policy shocks. And if history is any guide, those who stay focused on the long term are often best positioned to benefit when clarity eventually returns. In times like these, it's natural to want to act But history shows that reacting to short-term market swings often hurts long-term results. The recent pullback in U.S. stocks has been uncomfortable, but it hasn't changed the purpose or power of a well-diversified portfolio. Diversification across asset classes, sectors, and geographies continues to work. While U.S. large-cap growth stocks have struggled, areas like international equities, bonds, and non-tech sectors have held up better, creating new opportunities to rebalance and position for the future. Periods of market weakness can allow you to tax loss harvest underwater portfolio investments. We're monitoring for opportunities to realize strategic losses, which may help reduce future tax bills while keeping your investment strategy intact. For long-term investors, the key is to stay invested and stay disciplined. Missing just a few strong rebound days can set you back significantly. Instead of trying to time the market, consider dollar cost averaging. Investing consistently through periods of volatility can help turn down markets into long-term gains. Finally, uncertain times are a great reminder to revisit your financial plan. If your goals or situation have changed, we're here to help make sure your portfolio still reflects what matters most to you. If you found this information helpful, please click like. Click the subscribe button to be notified of future videos. Thanks for watching.